How is it that a stock trading at $20 can be substantially more expensive than a stock trading at $500? Another example is how is a stock market that's down 10-15% from their all-time highs can be considered more expensive than when it was at its all-time highs? My name is Michael Petracca, and I'm the owner and operator of HAP Financial Group, and this is your tip of the month. So for this month, I'm going to focus on how we analyze stocks or the stock market, and one of the formulas we would use to determine if stocks are cheap or expensive. And what that's called is more or less your PE multiple. Now, to break that down a little bit, if we're analyzing a stock or the entire stock market, and we're trying to figure out why is it going up or down, when utilizing the PE formula, it's either the earnings going up or the multiple going up. So, for example, let's say the earnings or the economy are going up, revenue and net income are going up, but the confidence in the market is going down. So even though the economy is improving and the earnings are going up, the stock market could still be going down. So there is a loose correlation between the stock market and the economy. And the best way to determine kind of how everyone's feeling about it is what's going on with the multiple on the market. And so to use a example that's not associated with the stock or bond market, and sometimes helps when I'm going over this with clients, is using a rental property. So let's say my office rents for $10,000 a year, and you want to buy it from me. So what are you going to do? You're going to do your homework, and you're going to see what are the other properties selling for. And you find out everyone's selling for about 15 times rent. So to determine how much you should pay for it, you do the 10 grand of rent times 15. You should be able to buy this property from me for 150 grand. Now let's say we pick up the newspaper tomorrow and we find out in Fairfield, New Jersey, where my office is, there's going to be a train station that goes right to New York City. Obviously, the value of this land has gone up. So even though my rent has stayed exactly the same of 10 grand a year, that multiple you're going to have to pay to buy it from me is going to go up. So let's say it goes up to as high as 20 times earnings or 20 times rent. Now let's say that falls through, and then we have, instead of a train to the city, we get a flood in Fairfield. So now no one wants to come to Fairfield. So the days of me getting 15 times rent or 20 times rent is now gone, and I might get about 10 times rent. So an example of this in the stock market is you can look back at the last 100 years, and a high percentage of the time, that multiple that we're going to pay to own stocks typically falls between 10 and 20. So if we look back at a bad time, let's say the 2008 financial crisis, it was 10 or a little bit below that. If you have the opportunity to buy stocks that cheap, probably the next 5 to 10 years are going to look pretty good in terms of rate of return. Now the reverse side, if stocks are trading at, call it 20 times earnings or north of that, you're probably going to have more muted returns going forward. So when we're trying to determine at any time if we're buying stocks cheap or expensive, we can say, well, what do we have to pay? What is that multiple that we have to utilize to buy stocks? So history would tell you somewhere around 16 plus or minus a little bit is probably about average. So right now we're halfway through 2023 and we're trading at about 18 times earnings. It's slightly expensive, nothing over the top, but that is certainly one way that regardless of where it is in terms of a price of the stock market or a stock, we can compare it to the earnings. And based on those earnings, do we have to pay a high multiple or a low multiple to buy it? Now, if you have any questions on how the multiple works, or if you want to take a deeper dive, always feel free to give me a call or shoot me an email. Happy to help. Thanks and have a great day.